Hey, how's it going? This is Matt here from Silver Fortune, joined once again by one of my viewers, I think, favorite guests, Lewis from his channel, Smaulgld. Lewis, how are you doing today?
Matt, I'm doing great. Thanks for having me on again.
Yeah, absolutely. I like these discussions because I think you and I, even if we don't always see eye to eye on everything we talk about, I think we have a civil discussion about it, an intelligent discussion I think a lot of our viewers like. And so usually these videos are shared on both my channel as well as yours. There's a ton of stuff to talk about, but I did want to start off with precious metals and kind of get your take on, I guess, if you want to call it recent movement. There hasn't been a lot of movement recently, but I guess the big question here that I think a lot of people are asking is, are we at a inflection point coming up here, kind of towards the end of 2018? It seems to be the case that metals are going to break out one way or another, either down below $14 for a while, or what I tend to think that they'll do pretty soon here is kind of follow the seasonality pattern that they have over the last couple years at least, where December tends to be a down month, maybe the lows for the year or pretty close, and then heading into January, February, March, they tend to recover. But I wanted to get your take on are we about to kind of round a corner here for silver and gold?
I actually think so. I did a blog post a week or two ago talking about all of the inflection points that we've had. And the issue we've had in the precious metals markets with inflection points is they come and they go. But I think we have a bunch of them, and they generally, what's happened in the past few years, they get solved. And so, for example, the stock market starts to fall in early January, early January 2016, early January 2017. Everyone says, this is it, and then it gets settled. But right now, we have a number of issues on the table. We have China, which has not gone away, though we have not sorted out whether there's going to be a prolonged trade war, what the impacts of it will be, if there is indeed a resolution, what the impacts of the resolution will be. So you have that issue. Then you have the stock market has been at all-time highs for years, and the other day I did some research and I saw it over the last 10 years, the GDP growth has been 25%. That's the cumulative GDP growth from like 14 trillion to 18 trillion in the United States. And the stock market's gone up threefold. So you can't really continue at that rate. That's showing that the stock market is way ahead of itself. So again, we keep thinking, well, when the stock market finally reverses, that money will flow into precious metals. Problem is the stock market hasn't reversed. But now we're seeing issues with the Fed raising rates. Perhaps we now had the inverted yield curve, which I also did a video on, which has historically shown that a recession is coming within 6 to 24 months. Now, the reason I don't place a lot of stock in that is a recession is always coming at some point in the business cycle within the next 6 to 24 months, other than the past 9 years when we haven't really had a recession. But there's only so long you can continue to do market intervention to keep the markets going until at some point you really run out of steam, unless you just want to totally create false markets, which we may be where we're at, Matt. But the idea is that we've had these inflection points and they've never panned out, or like Brexit, and then, well, it's not that big of a deal. But I think right now we do have a lot of issues on the table. And what's very encouraging to me from the precious metals is in the last 3 weeks, we've had the markets shoot up and the markets shoot down. And in both instances, gold especially still rose, irrespective of whether the markets went going higher or the markets went lower. Now, normally you'd expect when the markets crater that the gold and silver would take a bid. But when the markets are going up, gold is still going up, and that tells me that that volatility of up and down is actually helping gold, and then to a lesser extent silver. And you know, my view on silver is that silver has to follow gold, and gold has to break out first before silver goes. And if gold has a sustained bull run, then silver certainly will follow.
Yeah, that's kind of, I guess, you and I agree that silver tends to be more volatile. It falls more, it rises more. I'd kind of agree with that. I talked to, I think this was last week, Steve Sanangelo. I'm sure you're familiar with him. I'm sure many of my viewers are familiar with him.
Oh, yes.
And it's something he was talking about in terms of precious metals is that, those of us that are on kind of the more real money side of things, buying the physical and all of that, and how we kind of swear off sometimes, like, who would just buy SLV when you can buy, straight up silver? For most people that are looking long term, it might not be a great option, something like SLV, a paper contract. But he talks about how, if we want to really get a rally going in precious metals, we're not talking $2,000 gold, $50 silver, anything like that. But like, could we get gold up above 1,300 again, 1,350, and maybe silver up to 17 or 18 again? He sees that rally kind of starting in the paper markets, which is obvious. I mean, it is a completely paper market, but a demand-driven rise because of a shift in, I guess, perception, I guess, and where the markets are going among hedge funds, technical funds, et cetera. And so, once you see them rise above a couple key levels, you'll see their moves into silver and gold kind of shift from a neutral or a short position to a longer position. And I tend to agree. And we're seeing that right now. I mean, there have been periods over the last year where we've seen people come out, a host of articles or whatever, experts come out and say, we're thinking about shifting more into gold. We're kind of turning bullish on gold for reasons A, B, and C, and it hasn't really turned around. And so this could be, totally false alarm, but, kind of in line with seasonality and whatnot. It'll be interesting to see if,
Here's this thing, back up Steve on that. If you look at both the physical and the paper markets, right now, for the last couple of months, the net commercial, net non-commercials have all been very close to short, if not outright short. That's on the paper side. On the physical side, we had the worst year. It's not finished yet, but I believe the mint is about to shut down, the U.S. Mint, and they only sold about 15.3 million American Silver Eagles, the lowest since like 2007. Now, the physical market for silver, let's focus on silver. In 2015, the investment demand was between 22 and 25% of overall demand. And anytime you have investment demand, that eats into the available silver that's otherwise used for industry. And in the last 2 years, the physical demand for silver globally has fallen about 60 to 70%, so that now investment demand is about 12 to 13%. So what Steve is saying is that if, and I believe you're saying this as well, and I would agree, that if you have a move back into investment silver, seeing that the other demand for silver, the demand for silver for industry, solar panels, electronics, has remained relatively constant. It's not going gangbusters, but it's remained relatively constant. And that Indian silver demand for silverware and jewelry, which are the two largest portions of demand, are increasing. If you add to that, then finally an increase, it doesn't even have to be back to 2015 levels, where it ended up being silver demand for physical investment products like silver eagles, Canadian maple leaf, silver bars, things of that nature. All you have to do is add in on the physical side, instead of keeping the whole pie the same size or growing the pie and having that 12%, not necessarily of investment demand for physical silver, go not to 25%, but bump it up to 18%, and then you start to see somewhat of the tightness and somewhat of the interest in silver, and then that probably flips over onto the paper side. So I don't think that moving from off the bottoms of 14 is a stretch at all, and I think if you continue to have turmoil, as we mentioned, plus there's U.S. domestic turmoil with the Democrats coming in, you've got the whole Mueller probe, you've got the Clinton Foundation issues, which we're not going to go into. You've got the French Yellow Jackets. You still have the Brexit stuff out there. So there's a lot of reasons now where this turmoil has been managed to settle itself out, sort itself out, and assuage the markets, calm the markets. At some point, there is something where people say, let me just move a small amount over into the precious metals, and silver especially. You don't need to move much over to move the market, because it's a $13 billion market. When I say $13 billion market, that's give or take the value of an annual mining supply of silver at the current prices.
Yeah, no, I absolutely get what you're saying. Yeah, basically, what he's saying is that there's a paper side of it, but this physical demand, it'll come eventually, coins, bars, etc. But there's kind of a basement to how low, I guess, physical demand, in theory, how low it could go for investment demand. But that with market turmoil, with a move up, a significant move up or down in metals, because that tends to be what increases demand, then we could see the investment physical side of things matter more to the price than just what the paper markets are doing or what's just going on in the industrial side of things. I had two kind of interesting I guess observations on what you're saying earlier. The first one was I was listening to I think it was Chris Martenson from Peak Prosperity the other day, and you use the term, and I use it all the time too, business cycle, and he was talking about how in the last 10 years plus now, we don't really have a business cycle anymore. That it's more accurately could just be considered a credit cycle, right? Because a business cycle makes it sound more corporate driven or something, whereas now it's more debt, more centrally driven by central banks. So I thought that was kind of interesting, just his observation on that. The other thing I wanted to talk about was the Fed. You're talking about the Fed and their well, I guess less confidence in them following through on their original plans of tightening monetary policy by another, I guess, 1 or 1.5 percentage points in interest rates and continue to unwind their balance sheet. That along with the yield curve inversion. I was wondering if you give your thoughts on this kind of just decreased confidence in the stock market, the Fed, the economy, which I think it's fascinating. If you went around and you asked some mainstream analysts, economists, et cetera, maybe a year ago, even 6 months ago, when we had that really high GDP print, and you asked them, what are the odds of a recession occurring, in the next 12 months, or what are the odds of the Fed halting their current rate hike policy in the next 12 months, they would have said, slim to none. I mean, if you look at the data, if you look at what the Fed's saying, if you look at this, but now all of a sudden it's shifting to, well, yeah, the Fed said this, but we're not so sure if they're going to fall. Just a lack of confidence in what the Fed is saying. But I was wondering if you can kind of give your thoughts on that as well.
Okay, well, on the credit cycle issue, that is definitely true what Chris is saying, because we've had market interventions from central banks on a massive scale. And the goal there is to boost asset prices. There's no two ways about it. It doesn't boost, per my example, GDP up 25%, stock market up threefold, 300%. That's really or 200%. That's really showing that is the goal of central bank intervention. So the business cycle is less important than the boosting of assets, which are not in a cycle. They've just moved higher and higher. And you see that from the EU, the ECB, the Bank of Japan. China's off the charts. Every central bank is intervening to move everything higher. And as you say, well, what does that do for confidence in the Fed? What the Fed has been trying to do is distance itself from the other central banks and say, hey, we're not at zero interest rates. We've got rates up over 2%. We're not doing QE. We're reducing our balance sheet. And they're trying to get away with it. And if you remember the whole point, or not the point, the justification they were saying about QE, it's just temporary. And once we reach, the term was called escape velocity, where the economy can go off on its own, we'll start to unwind this and we'll start to raise rates. Well, the economy never reached escape velocity, but the markets did. They kept going higher and higher, and they've managed to keep those stock prices higher. And I think that the U.S. has its number one goal is to protect the dollar, and that's why the Fed raised rates to make sure that the bonds are on sale and people would still want to buy U.S. Treasuries because they pay a rate of interest, and it also boosts the value of the dollar index versus the other currencies. But also, the second most important thing to them, they work in tandem, is keeping asset prices on the U.S. stock exchanges higher. Why? Because it brings money back into the United States. You see the Swiss National Bank has $1 billion invested in U.S. stocks. The Saudi Arabians have even more. And the idea is to keep this dollar and the stock market both with a lot of confidence. And they do that, and they're very clever about it by timing their rate hikes, what they say about rate hikes. And what you saw yesterday, they appeared to cry uncle in a sense, where late in the day where it looked like we were going to have our second day of markets just cratering again, the Dow was down another 700 points, all of a sudden, magically, the Wall Street Journal has an article, very nebulous, that the Fed officials are thinking about changing a wait-and-see policy on raising interest rates, and boom, stock market turns around, regains a few hundred points, and problem solved. But this is my point, back to all these turmoils and all these putting the fingers in the dike and all these different, shutting down each bit of turmoil. There is a point where you can't keep doing it, or at least this is what we've all been saying, but maybe, just maybe, we are reaching that inflection point where you can't keep putting Humpty Dumpty back together again. You can't keep reheating the souffle, and at some point you have a bit, at least a correction that they can't control, and people see this volatility. They see that gold and silver have been constant during this. We haven't mentioned cryptocurrencies, which have taken a complete dive. So there's no safe haven there for all the store of value people out there. Oh, Bitcoin's a store of value. Yeah, buy it at 20,000, hodl it to 3,300. So gold is really showing the store of value. Silver is showing the sister store of value, the little brother store of value. And that shouldn't take much for people to realize as they're seeing this volatility back and forth. And again, the Fed can only do so much, and they are masters at it. You have to give them credit. They did manage to take a tepid economy and boost into a roaring economy, a roaring stock market and a roaring housing market. But just like China, it gets ahead of itself. It's all debt-driven or interest rate or credit-driven, as Chris Martin would say.
Yeah, to add to that, talking about the stock market, it is, as we saw yesterday, it is incredibly easy for the Fed to boost the stock market. They just need to leak a little thing to the press. Like, they don't even need to say anything. The press can just say, we heard from a Fed official, such and such. And all of a sudden, as you saw, the Fed market, or the stock market, absolutely turns around on the news.
The Fed didn't even call a press conference. They didn't do anything. They leaked to the guy at the Wall Street Journal who puts out a tweet, and next thing, in a little article, and the stock market recovers.
Right, exactly. Now, what's interesting, and this is another observation I heard recently, so by no means my own idea, and I forget if this was Chris Martinson or if this was Julian Brigden when he's on the Macro Voices podcast, which is a great podcast for, if you don't listen to it or my viewers don't, it's a great one out there. Anyways, he was this individual, he's talking about how pumped up the stock market is not a big deal for the Fed. And again, we saw more evidence of that on Thursday. But the one thing that the Fed can't easily do without significantly changing its policy, and we're talking like significant loosening ultimately, or at least stopping what their current plans for interest rate hikes and balance sheet normalization, is the housing market, which has kind of become a pain point, I guess, for the economy over the last couple of months. A lot of signs of weakening, not full-blown collapse, but just a lot of different signs. And I know you have some experience in the real estate market, the housing market, but that's something that the Fed can't, I guess, pump up quite as easily, right, with just a quick leak to the Wall Street Journal.
They kind of can, because they can do what's called dovish rate hikes, which is they raise the rate, but then they say, well, we're not sure what's going to happen next. And that forward guidance does have an impact on interest rates and could rein them in, even though they may sneak a few more rate hikes in on the Fed funds rate. But you're right, it is much harder because there is a real world impact that people have to actually dig into their pockets and pay a price for a house based on their income and the credit and the mortgage based on how much the percentage rate is. Whereas stocks, whether Apple is $300 a share or $600 a share, doesn't really matter. Maybe Apple does because it's the largest stock, but for many stocks like Tesla, it doesn't matter what your income is, you could still buy it. It doesn't matter whether it's $300 or $200 because there's no earnings anyway. So they can create momentum in those types of shares, and unfortunately those types of shares do make up the bulk of a lot of the NASDAQ and the S&P. There's 30-40% of those companies, talking without precise knowledge, but a lot of them don't have earnings, or don't have earnings that are anywhere near your traditional 15 to 20 PEs. I mean, they are catastrophic. They're astronomical.
Yeah.
But yet they can still boost those prices because they can't become unaffordable the way a home can become unaffordable. So the housing market is trickier, yes. But they can do things like forward guidance to try to keep rates a little lower.
Yeah, absolutely. And it's kind of interesting because, you know, the stock market, it should act much more rate sensitive than how it does oftentimes, because
Absolutely.
I mean, you look at some of these, and you know, you brought up Tesla. You know, is Tesla sensitive to interest rate hikes? Yeah, I mean, they have an incredible amount of debt. Now, Apple, on the other hand, with a lot of cash, maybe not quite so much, but absolutely, with the amount of corporations out there that are heavily in debt. You know, you hear about these zombie corporations, the ones that can barely or maybe not even make their interest rate payments on a month-to-month basis. Another quarter percentage point, another half is, I mean, it's kind of game over for them.
Well,
so absolutely,
that is where there's an Achilles heel, but that's where the stock price in many instances is tied to their debt service. I think a lot of them have triggers on if the stock price is over a certain price, they don't have to pay the debt obligations don't convert.
Well, yeah, that's certainly the case for Tesla, as far as I know.
Right.
They have a big one coming up in, I think, January, and if they keep January or February, you know, if they keep the stock price above, it's a pretty high level. I think it's just shy of 400. Then they don't have to pay out the bond on that one. So yeah, that'd be another example of that. You know, another kind of interesting thing that I've noticed lately with talking about the Fed is in many ways I think they've kind of backed themselves into a corner. So there's gonna be a lot of talk, you know, coming up in December, their December meeting, and certainly their next meeting, which would be in like February or March, I think March is the next one that people are expecting them to hike rates. There's gonna be a lot of, I guess, going back and forth. Are they going to continue? Or are they going to wait and see, or whatever? But you know what I find really interesting is that regardless of what the Fed is saying right now, regardless of what they do in December or March or whatever, you know, there's another policy that they're undertaking right now, kind of passively, that people have kind of been silent about, and that's the balance sheet unwind, quantitative tightening, which is at its fastest pace now. As of October of this year, they've been unwinding at about $50 billion a month between their treasury bonds and mortgage-backed securities, and that has the effect of tightening. You know,
correct.
Maybe not as suddenly as maybe a quarter percentage point in the Fed funds rate. But that's kind of interesting because they have to, you know, unlike with the Fed funds rate, where they have to actually take action to tighten the markets or take action to say, no, we're not going to tighten or whatever. This is something that's going on passively in the background that I think people are not paying attention to enough, and they have to take action to actually end it. You know, they actually have to come out and say, you know, we had this goal of normalization, and we're nowhere near that. You know, we're talking, you know, if this happens 6 months from now or whatever, but we're going to, you know, stop this policy anyways, or we're going to slow it down to $20 billion a month, you know, a snail's pace like that or something like that. And I find that really interesting as well, because that's something, the liquidity that QE provided to the market, to the whole economy as a whole, is constantly talked about by individuals like you and I, and yet you're seeing a lot of people kind of ignore this ongoing kind of stealth tightening that a lot of people just, I guess, aren't, I guess, cognizant of when we're having this discussion about Fed tightening. I guess, what are your thoughts on that?
Well, the other thing they do, what they used to do when they were doing quantitative easing, and then even after they stopped it, they'd continue to roll over the bond. So one of the things they can do is stop actually selling, but then they can also just allow a lot of the stuff to roll off the balance sheet. I haven't looked at the portfolio, what the mix is. I don't think they don't actually tell you what the mix is on how many 10-year, 30-year, or whatever bonds that they might be holding.
They do actually, yeah.
Oh, they do. Okay.
If you go to the website, they have it all. The general length from 30 to
oh, I'm
year
sorry.
long or whatever.
It's the when you look at the Fed tick, when the Treasury depot, you can't tell what the foreigners have. Yes, but
oh, sure, yep.
But the confidence that it's dual-edged. When they raise rates, you can view that as confidence in the economy. You see what I mean? Because you're saying, well, we can withstand this rate hike. If you continue quantitative tightening, It's the same thing, confidence in the economy. You're concerned about a point where they have to come out and say they're not doing it anymore, that they're gonna stop. And the way they would do that is they would couple that with saying, well, we're going to lower it to a certain amount, or we're just going to allow things a wait and see approach. The key thing with the Fed is the markets are short term. They hang on the short term, whereas the Fed is, if you think about what they've done through all of their, I don't want to call it BS, but jawboning, is they've managed to keep the dollar strong, even though they did 6 years of QE. And that takes quite a feat, because when they were doing QE, there were points where there was a lot of people saying confidence is lost in the dollar. Then they start talking about, oh, we're going to stop QE. Then they're going to say we're going to taper QE. Then they actually do taper QE. And then they say they're going to raise interest rates. They talked about raising interest rates for almost 2.5 years before they actually did it. So it's the same thing on the flip side with the quantitative tightening. So we could be talking about ending quantitative tightening 2.5 years from now. Now, you would think they'd start it, if there's an issue, a hint of a recession, you'd think they'd start talking about that in March. But I don't think so, unless the stock, it all depends to me on where the stock market and the dollar are. That's what they really have their eye on. The dollar first, and then the stock market second. I think Peter Schiff says they would sacrifice the dollar for the stock market. No way. Because without the dollar, they don't have the stock market. They don't have a game. They don't have all the things they can do because they have a strong dollar. They don't need the dollar index to be at 100, but they can't have it at 60. So they try to keep it within that range, and they have. At the worst parts of QE, it was down in the 70s. And ever since then, they've managed to boost it since the end of QE into the 80s, upper 90s, and I think early 2017 it was over 100.
Yeah, it was. Yeah. I guess all I'm saying is that it's it does have a real effect on asset prices, whether we're talking about rates in the bond market, in the mortgage markets, that they are, as you said, usually when I talk about unwinding their balance sheet, you're right, they're not usually selling. When they mature, they're just not reinvesting those funds. They're not. They're basically they have.
That is a form of tightening, though.
Yes, it is. It is. For a long time now, they've been a major buyer in both of these markets, and they're a buyer that they're becoming a smaller and smaller buyer. And so, from just a basic economics, supply and demand perspective, you would expect rates to go up for that reason, right? And of course, the liquidity that's also kind of removed from the system, from the markets as a whole, you'd expect that to, at least if nothing else, make stocks more volatile. And so.
Do you know who buys a lot of? People have focused on the foreigners. That foreigners are dumping treasuries, de-dollarization. Okay, and that isn't really true. The Russians dumped about $80 billion, which is a spit in the bucket. The Chinese, the Japanese have tapered a bit, but they still have plenty. But who the big buyers are U.S. corporations. Google, Apple, Facebook. Apple and Google together have more than Germany have. They have like over 100 billion in treasuries, and with all the cash flowing back in, they got to put it somewhere. Where do you think they put it? They have it in treasuries. Yeah, so that's picking up a lot of the demand as well. So the Fed doesn't have to be like the Bank of Japan and buy every bond that is issued by the U.S. Treasury. There's plenty of demand for those bonds, and the amount outstanding just keeps growing, irrespective of how much the Fed may have on them. The Fed may reduce what's on their balance sheet. I think they had about $2 trillion, but the overall amount is like it's unbelievable, because you have 60 with the foreigners. It's a massive size. So even the Fed's participation is not. It's not the most dispositive thing, like the Bank of Japan, who basically owns every Japanese bond.
Yeah, and that's a whole other conversation. They're talking about Google, Apple, et cetera, and their I guess a lack of investment, for lack of a better term, in something, I guess, productive. I mean, that's what you'd expect when you have a corporation like Apple that is just swimming in cash. You expect them to invest that in something, and that kind of raises questions like what is wrong with our economy where they don't feel confident investing in a new major. People have thrown out things like Tesla or buying a car company so that they can begin an auto company, right? They can sell cars. I don't know if that's the best move for Apple, but something. Instead, they're just kind of treading water. A new iPhone, new iPad, or whatever. They're selling them. They're profitable. They have a very high.
What most companies do, their goal of all companies is to what they call maximize shareholder value, and that's generally reflected in a higher share price. If you produce better products, if you innovate, you invest in people, products, whatever it is, and you sell more and you get a return on your investment, your stock price goes higher because you make more money. But what companies have figured out in this environment, because the GDP is not roaring and because interest rates are low, they can borrow money and boost the stock price by buying their own shares back. And so that's why you don't have a productive economy, because everything looks fine. They invest their money because they realize that investing in products and people and innovation, there's not the large enough demand out there in the market for the products. So there is a demand for the shares, so they cater to that. And if the stock price goes up, it looks like the company's doing well. All the directors and officers' stock options go higher. The employee stock options go higher. And that's why San Francisco could be, and the Silicon Valley could be, a real tinderbox, because all those people working at companies that don't make a dime but have stock options going to the moon. That's why housing prices are so high there. It's not because it's such a beautiful place to live, although it is nice out there. But the small houses going for 1.6 million can only be financed through people using they're not ill-gotten gains, but their company stock option gains, which really are not a function of a normal economy. They're a function of the stock market basically being juiced up. And doesn't mean that those companies, if they don't make any money, that actually means they haven't allocated their capital properly. Or there's no business, or there's no business model, but the market somehow believes, I don't say it's the market, there's intervention in the market, that those companies that don't make any money somehow should be valued in the billions of dollars.
Yeah, it is really an interesting situation, especially as you're saying in California. Again, in a whole nother conversation, they're talking about the housing market and just how high it is in some select cities around the world. I wanted to close out this conversation with your take on the trade war. We kind of got one of our biggest updates on it, I guess, this past weekend. There's the big G20 conference. Trump and his advisors and some other leaders had dinner with President Xi Jinping. The big headline that the stock markets roared up on was that they're going to call a truce, I think, in December, or the end of December. No more tariffs for a set period of time. And I guess the market didn't really read the fine print. They took that as the trade war is over. U.S. and China are going to be friendly again on this terms. And long story short, Trump kind of, I guess, shot himself in the foot if his goal was to keep the market up. And he came out and said, no, I'm a tariff guy. It kind of threw some doubt as to just how solid this agreement was with China. Of course, since then, we've had the arrest of the CEO of Huawei, which is a major Chinese tech company that's been in the news lately. I guess I want to get your take on where this trade war is going. This is kind of your wheelhouse, more so than mine, geopolitics and whatnot.
You have to look at Trump as not being a ideologue on free trade, free markets, for tariffs, against tariffs. He came out the other day, he said, I'm a tariff man, which went against what it seemed to be his negotiating strategy was, to use the tariffs as a weapon in order to get tariffs removed. So, for example, country B had tariffs at 25% and we didn't have any tariffs on their products. He figured, okay, we'll raise our tariffs to 25% and let's see what you guys do. Maybe you'll lower yours down, or maybe we'll both get to zero and that'll be a good thing. And that's what I thought. And I still think that he's looking for balanced trade and that he's using the tariffs in order to get the others to come down. But I think what happened was he came out and he said, look, this is all going to happen in the next 90 days. And then China said, hold on, we haven't confirmed any of that. And that's what I think prompted Trump to say, I'm a tariff man, meaning, okay, if we're not going to clear the decks here, then I'm going to start saying I'm a tariff man. And he starts saying, if you want the privilege of coming into the country with your goods, you're going to have to pay almost irrespective. So I'm not even going for this free trade concept. I'm basically shutting you out right now. And that's the base point, not zero that you're negotiating towards. You're now negotiating towards there's going to be some tariff. Now, a lot of people that are free traders are against tariffs, because they think obviously there's no free trade and the world is a poorer place. But people don't remember. Of course, you wouldn't remember. You weren't born, nor was I. But the federal government used to be funded on tariffs, and that's why you didn't have an income tax, because the government was smaller and had to rely on being productive. And if people wanted access to our markets, then they had to pay to bring the goods and services in. So it'd be very interesting to see how it all breaks out. But I think Tariff Man, new superhero, Donald Trump, is a negotiating tactic. I do believe he thinks that the United States is special and you should have to pay to get access to our markets. But I don't think he's saying that you should have to pay amounts where it makes it prohibitive to access our markets. But I think what he's saying is that China basically doesn't pay much at all, and the United States has to pay a lot to get into China. So I think he still has the cards there. I think China's economy is centrally planned and it's been counting on the trade with the U.S. to finance their economy. A lot of commentators say, oh, they'll just turn around and sell the stuff to themselves. It's not that simple. And so I think that he's playing the game correctly. I don't know. The other thing is about this executive. The United States didn't arrest her. Canada arrested her. And we don't have the full story. They say she may be extradited to the United States. I haven't seen evidence that she has been. And we're not even sure why. They're saying maybe the company was dealing in Iran. But there's stories that maybe there's some criminality involved in what she or that company has been doing. Or maybe it has something to do with stealing U.S. trade secrets. I don't know. But they've made it, I think, into a bigger deal that somehow the United States stepped in it by doing this and is pissing off China unnecessarily. The two may be separate. This may just be a fraud case. I don't know.
Yeah. Something that could have been ongoing well before the G20 meeting or anything like that. I found it interesting that, I don't. Apparently Trump wasn't aware of it, but there were some other Justin Trudeau, John Bolton that were aware of her being arrested during the dinner. So that kind of throws another interesting thing in there. Well, is there anything else you wanted to, leave our viewers with today?
Nope. I think we're good. I think we'll just have to wait and see how this plays out, and we'll pick it up again in a month or so.
Yeah. Another thing to keep in mind in regards to the stock market and the economy as a whole and this whole turmoil and whatever is to remember the time of year here in the United States. We are moving into holiday season. Nobody likes to have talks of a stock market crash. You saw the other day this once again around holiday time we're talking about a potential government shutdown. The can got kicked down the road for another week or two, and I'm sure we'll find a deal right before Christmas time when no one's paying attention. And I wouldn't be surprised if we see some rallies in the stock market. Just less, talk about, where's the economy going? Is the stock market going to move into a bear market soon? Just because of perception, but I guess that remains to be seen. Who knows? Maybe it'll be different this year. Maybe the holidays won't be as cheerful for those that have large holdings in their 401ks or other funds in the stock market.
The big telling point is going to be when you get the first initial read on holiday shopping.
Yeah, from Black Friday, Cyber Monday, etc.
Yeah, have we seen that yet? I haven't seen anything on that. I thought we saw.
I don't know.
Well, no, I did see. We saw that the cyber stuff was up. We didn't see was up big time, but I didn't see that. It just doesn't mean it didn't happen. I just didn't see it. But generally, that's how they gauge the strength of the economy, because 70% of U.S. GDP is consumer spending. So it hasn't appeared to slow down.
Yeah. Well, of course, Black Friday came around and the headlines were as usual, record numbers, record amount of, I don't know who's measuring that and who's, you can't make the measurements over such a short period of time.
But you won't know until, that's the point. You really won't know until you see the preliminary results of companies, retail companies, and that won't happen until the first quarter of 2019.
Right. And of course, if they're low, people will just say, well, it was really cold that evening. On
weather. I always talk about the weather as if they didn't know what the weather was when they made their forward-looking predictions. We knew what the weather was in November and December.
Yeah, exactly. Well, anyways, it's been great talking with you again, Louis.
Likewise.
All right. I'll maybe have you on again, and I can come on your channel, whatever, for in January or, whenever more of this kind of plays out.
Yeah, let's do that. Maybe even for everyone's benefit, we do a mutual live stream.
Yeah, absolutely. That would I don't know how we'd rig that up. I'm sure there's a way to do it other than using Hangout so that we can both do it.
Oh,
unless we just did it on one of our channels or something.
You could do it. I've done it once. You do it on one of the channels, and then you just hook the other person in on Skype, and you can hear them, and then the questions come through on my channel or your channel, and then you can see them because you're logged into that chat.
Okay, great. Yeah, that makes sense. All right. Well, learn something new every day.
All right.
All right. I'll see you around.
All right. Bye.
Yeah. Bye.